Welcome to 3 and 3. Today we're going to be talking about the end of the Fed cycle, cash on the sidelines, and picking your spots. So end of the cycle. So the Fed has been raising interest rates since March of 2022 to combat inflation in the United States. Quarterly, the Fed updates their economic projections and expectations for the future Fed funds rate. Fed officials have paused further rate hikes, and forecasts show they could cut rates in 2024. The median FOMC projection is 3 rate cuts in 2024. The debate is around the timing. Some think as early as March, and how many cuts the market expects. 4 to 5 quarter-point cuts this year, whereas the Fed again is only projecting at a median 3 cuts. As you look back in time, you can see that Fed fund rates peaked in 2006, 2007, before they came down pretty quickly as the Great Recession occurred. And you can see this trajectory again as the Fed has raised interest rates at a pretty dramatic pace and now into 2024. And future projections are for that rate to come down from 25 to 26, and at some point maybe settling in the 3.25 to 3.5% rate from the current rate of 5.25 to 5.5. Cash on the sidelines. So in Q3 2023, total money market fund balances reach an all-time high of 6.1 trillion. High money market balances can be attributed to higher yields and economic uncertainty. Since October 2022, equity funds had actually lost 240 billion of outflows, while money markets had 1.1 trillion in inflows. The large amount of cash should actually provide some support to the stock market if there are declines. And also, as yields start to come down in money markets, people are going to start to look to other places to deploy this cash. As you see this chart, you can go back and see that this is the highest recorded money market balance we've had in the history, even higher than before the Great Recession. And as you look at this chart, you can see fund flows by asset class. Institutional and retail money market funds continue to see dramatic inflows. Bonds actually stabilized, and we saw those outflows in equity mutual funds and ETFs. Picking your spots. So picking spots will be important in 2024 as the economy and market face various potential challenges. Potentially trade wars, of course, China, politics again, election year, possible recession, and the long lag effects of the monetary policy of the Fed. Investors will want to stay disciplined and diversified facing these potential headwinds. As you look at the chart, you can see factor investing may be more important in 24 than it actually has been in the past, being that quality and those minimum volatility stocks may offer some protection because of the balance sheets of the companies that are underlying those actual factor ETFs. Momentum or growth may lag, but again, that depends on if we have a recession or a soft landing of some sort. Thank you for joining us for 3 and 3.